And we are back to looking at a stock market that is powering higher. Minutes from the Fed policy meeting from September, seemingly not enough to move things one way or another. They barely register at all. We're going to break down what's going on and what we might expect from here. I'm Ilya Spivak, head of global macro here at Tasty Live. And this is Macro Money. What we're going to do here first is take a look at what the price action ended up being for today and how it ended up shaping the narrative that we've been following here. And then from there, take a look at what is likely to be next for these markets. Of course, it is a tricky environment here because being a macro sort of trader here is very difficult. There's no macro data. The government shutdown has basically derailed all of what we'd be looking at, or almost all of what we'd be looking at, to get our bearings. But nevertheless, price action continues to tick, and so we continue to look at it. So here is what we are seeing for today. Stocks have a potent rise. Whatever sogginess there was yesterday shrugged off with gusto. The S&P 500 up 0.6%. NASDAQ up 1.25%. What's interesting is that yields ultimately don't go anywhere. Crude oil continues to recover a bit, but still inside of the decline that we saw last week. Of course, we saw crude had a sharp 7.4% sell-off last week. We're still attempting to claw our way back and only about halfway there. Gold continues to power higher, absolutely breaking through any and all semblance of a barrier, up almost 1.5, 1.47%. And so as we look at this now going forward, we find there's really not a distinct reason one can point to for this gold rally other than sort of generalized desire for some sort of store of value that isn't the traditional, that isn't cash. But it is very difficult to come to the conclusion, as some in the markets have, that what this is some sort of a debasement of the US dollar. I mean, that's very plainly wrong. Because what you see, among other things here, is that gold and the dollar are going up together. And while bonds don't have a big move here today, and in fact, at the 2-year maturity, they come back in a touch, bonds are not falling. In fact, the up move in bonds remains. So this sort of idea that there's some kind of a sovereign risk in U.S. assets is not based in reality, as it were. Since the Fed meeting last month, bonds are, on the whole, still up and moving higher, though we had a little bit of a pullback because the Fed turned out to be less dovish than the markets thought, so yields ticked up a tad. But the trend in bonds that has been durably pointing higher now, all the way back to late May, it is very much intact. Moreover, just in terms of near-term price action, we can see here, sure, gold is up a lot, but also the dollar hasn't had a lower low since July, and even just over the past day here, euro off by 0.25%, the yen continues to sell off, down almost 0.6%. So this move in precious metals is not a dollar debasement move, else the dollar would be down, and it is not. it's not a U.S. sovereign risk move, which would be sort of the parallel to dollar debasement of some kind. Bonds are not crashing. So something else seems to be going on here. There's all kinds of theory making one could have. Certainly, an 11th consecutive month of China buying gold in size for their reserve account. That's a part of this, surely. Not the whole thing, but at least to some extent. The possibility that the Supreme Court might overturn the Trump administration's flagship tariff batch. Not all of the tariffs that the administration has pursued are contingent on national emergency grounds via IEPA, but most of them are. And a lower court has said that the president can't make that argument, that there isn't a national emergency, that all of these tariffs can be reasonably tied to, and so he doesn't have the authority to levy these tariffs. It's going to the Supreme Court. We're looking for a ruling perhaps sometime this month. Maybe gold is up just on general defensive grounds because we have now 6 months that the markets have benchmarked a key pillar of economic reality as we find it today. And if this Supreme Court decision goes the other way, then we're back to square one. We're essentially back to early April as far as trying to figure out what tariffs we have or don't have and what all of it means. Because I don't think it's reasonable to conclude that if the administration is ruled against, then what they'll do is go, oh, well, I guess we didn't get it. Maybe next time. Pack up and go home. No. Almost certainly, if the IEPA logic is overturned, the administration will try to deliver these tariffs by some other way, contingent on some other powers, or figure out some sort of other way to get this done. So that opens up a whole basket of uncertainty around what fiscal policy is going to look like. So maybe that's what this is about to some extent as well, and sort of adjacent type of things. We still are waiting for the hearing on Lisa Cook. She gets to stay as Fed governor, but we'll hear in January, once oral arguments are done, if that is going to continue to be the case. So maybe what we're seeing in the precious metals is just generalized hedging against non-linear event risk. But for what it's worth, dollar debasement doesn't seem to be what this is. So, with that in mind, we move on to what we heard from policymakers today. As ever, in the absence of data, we are in Fed watch mode. We had another big batch of speeches today. Nothing of substance from Mosalem or Barr today. And of course, we heard from Kashkari yesterday. He's in a kind of Fed consensus state where he's saying, look, we don't know what the impact of the tariffs is going to be on inflation yet. We need to be cautious. We need to take it one step at a time. If we do too much easing, we're going to let inflation out of the bag again. We don't want to do that. So that's the majority of the Fed, and we know this consensus already. The interesting bit on the calendar today were these FOMC minutes from September. And here are some highlights from those. Almost all participants supported the cut. Shock of shocks, one wanted a bigger cut. There's no way to know, of course, that this was Stephen Miran, the Trump administration's appointee on the board most recently, who paradoxically still nominally holds a job at the White House as the chair of the Council of Economic Advisors, though apparently he's on leave from that role while he serves out until the end of the year, the term that was vacated by Governor Adriana Kugler. But clearly, when we look at the dot plot here, everybody is here. One person is here. And we heard from Governor Miron yesterday. He clearly doesn't seem to see any sort of conflict or tension between, on the one hand, asserting that the economy is warming back up, having been weaker in the first half of the year, which is incidentally encouraged by at least some economic data, not all of it, but at least some. And at the same time saying, well, this doesn't have any implications for monetary policy, this strengthening. We still need aggressive easing. Just look at how much the markets love aggressive easing. Surely that means this is the correct policy, which is high comedy because, of course, when have the markets ever not loved cheap money? So it's interesting to sort of tie things up that way and say, well, this is indicative of anything at all other than financial markets like cheap liquidity. So, of course, but in any case, we clearly have the sense here that there is the Fed consensus and there is now this sort of lone voice in the wilderness, which falls closer to what the administration might have said. Most participants judged that downside risks to employment have increased and upside risks to inflation have either diminished or not increased. That's how we ended up with that cut. We knew, of course, as much looking at the policy statement itself, which asserted essentially this. Most participants judged that it's likely to be appropriate to ease policy further. We know that also. We can see here we've actually somewhat retrenched on rate cut expectations. The probability of a cut has come down for the October meeting to 92%, whereas we were at 99% a week ago, but it is nevertheless commanding. So we are very much on course for a cut when the Fed meets this month. For December, we're back down to 70-odd percent, about 77, down from well north of 80 and closer to 90. But again, still very much a convincing rate cut story here. In fact, as long as you're, I would argue, durably above 60, it's kind of a given that you're going to get this cut. So most Fed officials think another cut is coming. The markets generally agree. Almost all participants noted that with the reduction in the target range, so this rate cut, the Fed is well positioned to respond to whatever comes next. So if inflation ends up looking like it's more assertive than the Fed judged, if we get a weaker economy than the Fed expected, all of those things apparently in scope here, the Fed feels like they're not behind the curve, they're not in a hurry, they can essentially move as they've been moving and find themselves sort of in a relatively comfortable space. The interesting thing comes here where a majority of participants emphasized upside risks to inflation. We know which one, of course, thought that this was not a big deal. In fact, we heard from Governor Miron yesterday who said that he's just not as concerned about inflation as other policymakers are and doesn't think the tariffs are going to be a big deal there. But a majority is pointing to inflation readings moving further away from 2% and saying, well, what if this is sticky? What if the effects of the tariffs are greater than we thought? And what if inflation expectations end up getting anchored even if the tariff near-term impact fades? So most are concerned that inflation might run away. Most expected that inflation's effects vis-a-vis the tariffs will be known by the end of next year. So the market's still expecting, and the Fed officials endorsing this idea that it's going to be a one-off for inflation costs, not something stuck in expectations. We'll see to what extent that holds up. Some participants noted that by several measures, financial conditions suggested that monetary policy is not particularly restrictive. What a shocker. Stock markets are at record highs. Gold is at a record high. Silver is surging. What could possibly have told policy officials that maybe, just maybe, financial conditions are not restrictive? I am shocked and appalled. Several participants noted that financial conditions were supportive of economic activity. Well, so it seems, if they are not restrictive or not that restrictive, as it were. Indeed, we continue to see that the flow of U.S. economic data seems to be turning out on the whole better than expected. Obviously, we got some very soggy ISM data last week, and the official data that we usually look at is on hiatus while we figure out this government shutdown. But since July, data has tended to outperform relative to expectations. It's been this City Surprise Index has been sitting above zero and moving cautiously from the lower left to the upper right. We likewise see, looking at this GDP Now model from the Atlanta Fed, never mind what it actually says about third quarter GDP, it's not a meaningful estimate yet, still much more data to go in here, but the direction of the green line here tells us that the tone of the data going into this model every day, every other day, less so since the shutdown, that all of this has generally shaken out to be GDP positive, hence the model rising. So never mind the outcome, but the tone of the data seems to have been relatively positive. Now, what's interesting in this context, of course, is that we still have only one rate cut from the Fed on the menu for next year, and only one rate cut thereafter. We barely squeaked out 3 for this year, and that's because this weird dot basically shifted the average and narrowly bumped it that way. But the markets are still of a much more dovish disposition. They see 62 basis points next year. They see at least 36 basis points this year, and of course we've seen the probabilities now for both October and December, and the markets are erring on the side of there being cuts there. So we're in a situation seemingly where the market still thinks the Fed is wrong and not dovish enough, in particular for next year. There's still a big disconnect there. But of course, until we get some kind of economic data, there is no forcing function really to get a reckoning to happen. There is perhaps a little bit still on the calendar for Fed speak. Most importantly, tomorrow, we're going to get a speech from Fed Chair Powell. If we look at what's actually on the menu for these speeches, though, we can see what Powell is doing tomorrow is just giving the welcoming remarks at the Community Bank Conference in D.C. It's not anything that is immediately sort of evocative of market-moving information. It's not an economic outlook. We are going to get an economic outlook from Governor Michael Barr. We'll see what that entails. That could be something in the absence of other news, but we still have a seemingly glaring disconnect here between what the markets are thinking and what the Fed is thinking. On one hand, this kind of chart tells us that the Fed is right to be reluctant, and indeed, if we look at this relationship between the ISM service sector index for prices, which tends to have about a 2-month lead on official CPI and PCE numbers. We're supposed to get CPI. We didn't get it. But we can see here that the dynamics seem to suggest that we're due for some sort of inflationary run-up. It's unclear whether the Fed is going to care, because they seem to be saying that the impacts from the tariffs, such as they are, is something that's going to work itself out. Powell told us by the end of this year. Most officials think surely by the end of next, as we just learned in the FOMC minutes. So it's unclear whether the Fed would actually take the realization of this inflation that's getting telegraphed here as anything to suggest they should be shying away from more stimulus, but they certainly may not go at it as hard as the markets want them to. At least for now, though, this disconnect continues to linger without the markets feeling like it needs to be reconciled. For what it's worth, we have a relatively sanguine view in the markets about inflation, and we can see that inflation expectations, as they're tracked here by the break-even rates, 5-year and 10-year, they haven't really gone anywhere. So while the S&P 500 has gone higher, inflation expectations haven't rebounded from April's lows. We can see that what the markets were worried about at the start of the year clearly was a growth kind of concern, where stocks fell and inflation expectations fell, telling us that the markets were worried about some sort of a recession-like scenario. Since sentiment started to rebound in the stock market, we can see that inflation expectations haven't really taken off. So the markets clearly still worry that perhaps there is some kind of a growth negative thing that's going on here. But at the very least, that the Fed is not going to be hamstrung by surging inflation in its quest to cut rates, and they've clearly seemed to embrace as much. So looking at it in these terms, then, we end up with a relatively sanguine state. Exposure-wise, I am still looking for the dollar to continue to bottom, still short the Aussie, the pound. I doubled down on the euro short earlier this week, still short the Canadian dollar, looking for the greenback to continue to recover, because clearly it's showing some heroic strength here with all this talk of rate cuts and precious metals surging, and the environment seemingly saying that all should be going wrong for the dollar, and it very clearly isn't. And so that kind of resilience typically speaks to a tremendous reserve of strength. So I'm happy to be long that. Clearly, this attempt at taking pot shots at the stock market didn't work. So I'll be getting rid of this S&P position when markets open tomorrow. This is exactly why I use SPY to keep things small. It's exactly why I look longer duration to reduce my exposure to underlying delta. It's exactly why I use put verticals to keep my risk contained. Once again, fighting the stock market has not worked out, so that this will be a trade to take off. The bonds still working, so staying in the call vertical there, and still looking for this rebound in crude oil to falter, and for the larger downside break from last week to continue, and holding a little bit of a put vertical there. And that is macro money for today. As ever, we are here right after overtime, show that I typically co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things go therefrom. Likewise, writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.